I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
I'm Larry Mohn, president of the Manhattan Institute. I want to thank you all for joining us today. Last week, the Institute announced the launch of a new center, E21, and we hosted an event for a former Fed member, Larry Lindsay, and his new book. E21 represents an expansion of the Manhattan Institute's involvement in economic issues. And as part of that expansion, I'm pleased to say, this also involves hosting the much revered Shadow Open Market Committee. Established in 1973 by Carl Brunner and Alan Meltzer, the Shadow Open Market Committee has a long and prestigious history of informing the national discussion on monetary and fiscal policy. Going forward, the Institute will be hosting 2 major events a year with the committee, and we hope to find other ways to work together to inform the policy debate. I'll now turn things over to the head of the committee, Mickey Levy. Mickey is chief economist of Blenheim Capital Management, a global money manager. Formerly, he was chief economist of the Bank of America, and he's conducted research both at the American Enterprise Institute and the Congressional Budget Office. We're thrilled to be working with Mickey, and we look forward to a long and fruitful partnership with the Shadow Open Market Committee. Please join me in welcoming Mickey Levy.
Well, it's a pleasure to be here. I'm the administrator for the Shadow Open Market Committee, and probably the longest lasting member on it since 1983. It was founded in 1973. We're going to have 2 sessions today with the Shadow members presenting their position papers. There'll be a few questions of each after each paper, and then there will be time at the end for more questions of all the members. And then our guest speaker, Esther George, will speak after lunch. So why don't we get started, Marvin? All the Shadow members, come on up.
So my name is Marvin Goodfriend, and I'm going to moderate the first of 2 sessions this morning. We have a session that runs from 9:30 to 10:30, in which we have 3 of our members, Bennett, McCallum, Mike Bordo. Ben McCallum, Mike Bordo. Where's Mike? Oh, he's getting some water. I was a little worried. And Mickey Levy will present their position papers. The format is everybody has about 10 minutes. I will moderate a couple of questions after each person's presentation. And then at the end of the morning, we'll have a half hour, 45 minutes for general Q&A. Everyone will come up at that point, and we can talk about everybody's presentations all at once. So, Ben, would you like to start?
Okay, thank you. I was told previously that we had 8 minutes, but to hold it even to 10, I have to more or less read my paper to get through the material, so I'll be looking down frequently. My paper is more specific and technical and less fun than those that will follow. So at our meeting about 2 years ago, I argued that nominal GDP targeting, which was at that time experiencing a sort of surprising renewal of interest, would be an attractive method of conducting monetary policy, or part of it. In doing so, I did point out that there are 2 quite distinct versions of this approach, one featuring a target of constant growth rates each period of nominal GDP, and the other, so the constancy is from period to period, and the other one featuring a target of constant target levels, so that each period you look at, you draw a line that's rising at a particular rate, and then try in each period to hit the level given by that line. These two versions yield quite different targets at any time at which the current level is significantly different from the value that had been planned for it earlier. And most importantly, they have very different implications if the regime is started up, if it's begun at a time at which current GDP is greatly different from the value with which one might like to begin. Okay, so the scheme that I would like to see for adoption in the U.S. would be one in which the Fed would strive to achieve each period, which we'd think of as a quarter, perhaps, or each FOMC meeting, that would correspond to a growth rate of nominal GDP of about 4.5% per year or something in each quarter over the indefinite future. The other economists, more of these people who've been favoring it, have promoted a policy of having the Fed strive to return to a constant growth path that's been rising at 4.5% per year. And these levels then are on a straight line that goes back and starts at the level of actual GDP as of the third quarter of 2008 or some other time before the beginning of our long current slump. And so if you were going to do that, embark on that strategy today, you would find that we're far below now the level, and the jump that we would be trying to get back to that level is over 15%. And so they have quite different aspects to them, and the growing levels version is sort of asking maybe for a monetary splurge, which is the reason for that word in my title. Okay, well, because I'm a fan of this general approach, I was quite interested to learn from national newspapers a little over a year ago that at the Kansas City Fed's Jackson Hole Conference in 2012, Michael Woodford had expressed support for this, for nominal GDP targeting. And that was, of course, highly newsworthy because Woodford has almost surely been the most influential of all academic monetary economists over the past decade or so. Then after getting a copy of his paper, I was somewhat disappointed to see that it was the growing levels version that he was promoting. In his version, the path to strive for would be defined by what he describes as a log linear line fit to the data between the first quarter of 1990 and the third quarter of 2008, the last quarter before the zero lower bound became binding. Okay, now this seemed a little bit surprising to me in the sense that Woodford had, in another presentation at the Jackson Hole Conference, but way back in 1999, developed and promoted a concept of timelessly optimal monetary policy rules. And to work out the implications of these things, one has to do a bit of explicit modeling. So in the paper that I prepared for our meeting, I have about several pages of sort of formal analysis that's designed to bring out the difference in these two versions. Okay, so the analysis is conducted in a very small three-equation dynamic model with rational expectations that is clearly a drastic simplification of reality. But it is a model that's of precisely the form that's used by mainstream monetary economists to provide a tractable system that features the crucial forces and frictions that relate to aggregate demand and supply, the ones that any realistic model would need to incorporate. And it is precisely the same model as is featured as a starting point in the leading graduate school textbooks, they being three that come to mind are those being written by Carl Walsh, Jardie Golly, and Woodford, and as well as some famous and influential papers dating back to around 1999 by Woodford, Clarida, Golly, and Gertler, and Goodfriend and King. So when you try to compute an optimal policy in this type of a model, you run into a problem. That is that you need to you're trying to determine conditions that should prevail for all periods 1, 2, 3, ... into the infinite future. But you get one optimality condition that should hold in each of those periods. You get a second one that should hold in periods 2, 3, and so forth, but not 1, and a different one that needs to hold in period 1. Now you can combine these pieces of information together, and they lead to 3 different strategies for policy with respect to how things happen over time. One of them is dynamically inconsistent. In each period, it calls for a condition that differs from what had been planned in the previous period for this period. So that's not very attractive. A second is called discretionary policy in the literature, and it features a fresh calculation in each period that's constrained only by currently existing conditions and presumes that the same approach will be used in the future. And the third is the timeless perspective strategy that was introduced and championed by Woodford in his 1999 paper, and it is the one that is most widely used and accepted among academic economists. Now, the point in this context is that in this model, the third and most widely accepted approach does call for GDP targeting in terms of growth rates, not levels. Targeting in terms of growing levels is implied, by contrast, by the discretionary policy, which several analytical papers have tried to study these two, compare these two numerically, and have found that the discretionary policy performs less well than the timeless perspective policy. So that little piece of analysis, which takes up most of the handout that you have, is favors the view that I wanted to argue. Okay, now having made this argument, I want to say explicitly that it does not imply any error or inconsistency on the part of Michael Woodford. As he would no doubt emphasize, the discussion in his new 2013 paper is not concerned with policy rules at all. Instead, in this most recent piece, Woodford's concern is to devise communication strategies for informing the public about policy actions to be taken in the future, especially in the zero lower bound situations. And this is the topic that's called forward guidance, which he defines as explicit statements by a central bank about the outlook for future policy. Okay, now this recent paper of Woodford's, given in 2012, and the relevant body of research is really very impressive intellectually. But to me, this focus on forward guidance seems to serve to distract attention from the larger issue that the Federal Reserve has just not been willing to conduct policy in accordance with any consistent and clearly defined policy rule. Now, I think that a nominal GDP target could be helpful in guiding policy and in communicating with the public also, whether you're in or out of a zero lower bound situation. But But in a broader context, with respect to all of this, I would like to make an observation that of a different type. The observation is that prior to the introduction of the euro area, the most respected central bank, the most respected monetary policymaker in the world was the Deutsche Bundesbank. Now, the Deutsche Bundesbank was not really terribly good about its overt communications. Its statements were somewhat inconsistent with its actions. Its policy was effective, however, because the German public knew from experience that the Bundesbank was dedicated to keeping inflation under control at a reasonably low rate. So I think the message from this is that over time, the best form of communication is to have and to follow a cogent and consistent policy, that is, a policy rule.
Stay there, Ben. So we have time for a couple of questions, and if no one has a question, I will have a question. Anybody? Okay. So I think what I'd like Ben to elaborate on is the following. There's a subtle disconnect that's happened with respect to discussions of Fed policy. Common sense tells you that communication has to be based on something that people will believe is being followed by the policy authority. But the Fed talks about forward guidance as if it's an entirely separate instrument from what the public believes the Fed is doing, and that the public can be manipulated by sort of fancy rhetoric with respect to forward guidance. You know, in personal relationships, that kind of thing leads to what you might call lack of trust. And I'd like Ben to comment on that because he came very close to saying something like that.
My comment is, yes, I agree.
And then once you lose trust between you and whoever you're communicating with personally, what happens then? You lose the ability to communicate at all. And I think that's what's happened in the last few days with respect to the Federal Reserve. Sometimes people say it's a lack of credibility. What it is it's a misuse of rhetoric that's inconsistent with policy. This isn't a question. I got a little bit carried away here. But that's the kind of thing that Ben is saying, and that's why it's relevant today. Yeah.
How does GDP targeting make any sense whatsoever in an era of multi-trillion dollars of excess reserves already?
Well, actually, the question sort of points out, in a way, that nominal GDP targeting is not a full policy rule. It's it's a target. It's something that you want to achieve, but it's not. But it's just defined in terms of objectives. It's not defined in terms of the instrument that you can actually control and manipulate to get to that. And you know, the forward guidance material and so forth is about the lack of the link, between the two. So what was the?
No, I think the reason is that following Ben's point, the reason is that Woodford insists on talking about nominal GDP targeting is because he believes, irrespective of the actual lever that the Fed pulls, which is reserves, he can manipulate the public to think in a way by simply using rhetoric, using forward guidance, to achieve this nominal GDP target. That's exactly what he's trying to do.
Why do we even need a Federal Reserve for that?
Well, I mean, if we took a vote here, I think you might win.
It's all about government propaganda. It has nothing to do with monetary policy.
Okay, so the way I think about nominal GDP targeting as a way of deciding what you're trying to achieve macroeconomically, but that's not a policy rule, as I said. I would like to have some sort of a rule, like the Taylor rule, which is a rule because the federal funds rate is something that you can actually operate about. And it could be compared with nominal GDP targeting brought about by operating with the federal funds rate. Those would be two alternatives. Another one would be nominal GDP targeting carried out with a kind of policy rule that I used to write about back when the monetary base was thought about as a viable sort of creature for direct manipulation by the Fed. And so I think of nominal GDP targeting as simply a component in what would be a rule that should actually go back and dictate what the central bank is doing from period to period, one that's announced and coherent so that people can look at it and see if it's actually happening.
Okay, we've got to move on. Thanks, Ben. Okay, so Mike Bordo is our next speaker.
Okay, so I'm going to talk about the recovery of housing and the end of the slow recovery, question mark. So the recovery from the financial crisis of 2007 to 2008 and the Great Recession has been proceeding now for 16 quarters. The recent recovery is slower than every preceding recession with a financial crisis in U.S. history. And many people have argued that the reason the recovery has been so sluggish is that it reflects the severity of the financial crisis. So there's Reinhardt and Rogoff's book, This Time is Different, and a lot of other stuff that they've written basically makes this point. And I think the U.S. government's taken that line too. But this goes against the record of U.S. business cycles in the past century and a half. So according to something that Milton Friedman wrote many years ago, he said, a large contraction tends to be followed by a large business expansion. And he explained this tendency for a rapid bounce back from a deep recession by what he called the plucking model, where he had this idea that the U.S. economy was like there was a board, an upward sloping board that represented the trend growth rate, and then there was a string that was attached to this board underneath. And then a recession would be a downward pluck on the string, and a recovery was when the string bounced back. So the greater the pluck, the faster the bounce back to trend. So I did a paper last year with my colleague Joseph Haubrick at the Cleveland Fed, where we revisited the issue whether business cycles with financial crises were different from the general pattern. And we looked at 27 U.S. business cycles from 1880 to the present, and not only did we confirm Friedman's plucking model, we also showed that the deep recessions associated with financial crises recover at a faster pace than deep recessions without them. And what we find is that the recent recession is different from the historical average, and it's seen in a shallow recovery after a deep recession. And we argue in that paper that it's largely can be attributed to the unprecedented housing bust that we had. And a measure of that we look at is the collapse of residential investment, which until very recently, until about a few quarters ago, was way below its historical pattern during recessions. However, in the past several quarters, housing has roared back from its slump, and its recovery may augur the conversion of the slow recovery to a more normal pace. And if that's indeed the case, then the Fed should seriously consider ending its expansionary policy stance sooner rather than later, and should focus on its exit strategy. So that's the story. I'll go into it in a bit of detail. So what we did, what Joe and I did in our paper, which got a whole lot of attention in the press, I mean, all these different places, Wall Street Journal, et cetera, discussed this paper and the debate we got in with Reinhardt and Rogoff. So what we did was we measured the depth of a contraction by the percentage drop in quarterly real GDP from peak to trough, and we measured the strength of the recovery as the percentage change in quarterly GDP over the duration, which was the same number of quarters during the recession. And then we demarcated recoveries from recessions associated with financial crises from those which didn't have them. And what we found was that recessions that were tied to financial crises and were 1%, which were 1% deeper than average, have historically led to growth that is 1.5% stronger than average. And you can see this in the handout in Figure 1, where what we did there was we compared a regression of recovery strength against contraction amplitude, and we distinguished between financial recessions and those which weren't. And you can see that there's the upward sloping line is a financial recession, and the downward sloping line is a normal recession. And then there's a table at the bottom. There's Figure 2 at the bottom of that page, which looks at it another way in a bar chart. And what it shows you is that the recovery from the recent recession is considerably below the average of the previous 8 recessions that had financial crises. And we found out that this pattern holds up even when you account for measures of financial stress, like the quality spread between U.S. Treasury bonds and the BAA corporate bond, and when we account for bank lending. So when we account for all these financial factors, this pattern still holds up. So that gets us to the question of housing. And housing has been very important in many business cycles, and there's a lot of evidence that household investment, residential investment, tends to lead the business cycle. And there was a paper given by Ed Leamer at Jackson Hole in 2007 where he made this point, and he looked at housing and he said, you know, this is predicting a really big recession. And of course, he was right. And so the question is, to what extent do the problems in the housing market account for the slow recovery? So in our paper, we asked this counterfactual question. We said, what would the current recovery look like if it followed the historical pattern based on the depth of the contraction? And then we determined whether the difference between what the historical pattern shows and what we see for the last recession, whether that's due to financial factors or to residential investment. And so we compare actual with fitted values in a regression of real GDP growth in the recovery against the depth of the contraction. Then we added in a number of measures of financial distress to see what happened to this gap that had opened up between this recession and the average. And then we added in residential investment. And basically what we found, and the results are in Figure 3, but I'm not going to go through this in detail. But what we found was that the difference between the recent weak recovery and the historical pattern was almost entirely explained by a shortfall in residential investment. Okay. So, in a sense, what we found was that that had a lot to do with the weak recovery. So now the question is, well, what about now? So the housing market's turned up quite sharply in the past 3 or 4 quarters, and its turnaround likely reflects the operation of normal market forces in recovery of a business cycle, but aided likely by low policy interest rates and the Fed's LSAP policies. And you can see there are a number of indicators that people have looked at, like existing family home sales, which I have in this handout, Figure 4, the home price index, which has shot up, and then residential investment, which is turning in Figure 6. And so the question is, given what we've seen, this turnaround in housing, will the dramatic turnaround turn the weak recovery into something more like a normal recovery? So what we did was, to try to answer this, we used the same method that Leamer used to predict the likelihood that the housing decline of 2006 would lead to a recession. And so we turned it around and looked at recoveries. And so we calculated what's called the abnormal contribution of residential investment to real GDP growth. And we have the last figure is Figure 7. So you see these steep lines that shoot up, and they show that housing is a very important contributor. And if you look at it, you see that every previous recession had this happening. So the last recession, it's coming back. The line is now rising, but it's obviously got a way to go because we had at first there was a big dip because residential investment really was way below trend. Okay, so but it's coming back, and it seems like that if the recovery pattern that we've seen so far in the last three quarters, if that continues to follow its trajectory, then the current recovery should soon return to a more normal pace. And so let me conclude with just a couple of seconds with a policy lesson. So it seems like the turnaround in the housing sector should be a key factor to restore the pace of this recovery back towards that of the recoveries from previous recessions. But of course, this prediction holds a lot of other so-called headwinds constant, you know, the uncertainty about fiscal and regulatory policy, the new healthcare system, uncertainty about the rest of the world, the Eurozone, et cetera, et cetera. But another headwind is uncertainty over the Fed's exit strategy. So the debate over the tapering of bond purchases under QE3 and the opaqueness of the Fed's forward guidance policy can only be detrimental to the recovery. So the Fed should seriously be taking into account this evidence on the turnaround of the housing sector as an historically strong and significant predictor of the economy's return to health, and it should signal the need to accelerate the exit strategy. Thank you.
Thanks, Mike. Stick around for a minute. Let's see. We won't have a discussion. Marty?
Marty.
Yeah. It's right there.
Thanks very much. I agree, Mike, with what you said about the importance of housing in causing this to be a subpar.
Is the mic working?
Thanks. So I agree with what you said about the contribution of housing to the depth of the downturn. And I remember Ed Lemer's paper at the Kansas City Fed in 2007, in which he laid out the evidence that housing troubles that we saw then, well, it seemed to me very clear was going to point to serious recession. But at the time, he said it wouldn't. In fact, he said to me, I'll bet with you that it's not going to be a recession. And he said the reason for that is that manufacturing has now become such a small part of the economy. Housing alone can't do it, and without a significant downturn in manufacturing, we're not going to see a serious recession. Well, he lost that bet. But on the turnaround, so we've seen for the last few quarters that real residential investment is growing at about 15% a year, but from such a low base that it's adding about 0.3% to the GDP growth. And if it's now going to slow down a little bit from that 15%, it still isn't going to give us a very robust recovery. And so we're seeing, I think, once again this year, a GDP growth of less than 2%. So I don't see how to go from the evidence to, quote, normal recovery at this pace, a recovery that will get us from less than 2% to some 3+% GDP growth.
Yeah, so, I mean, I've thought of that, and I know those numbers too. And so if you look at, like those lines that he shows, so in a sense, we lost a lot of ground, and it's going to take some time. I didn't say it's going to happen right now, but if that trend continues, okay, given that housing does seem to be a very strong leading indicator and does seem to contribute, that is going to move us back towards a normal recovery, and that it's something that I think is an important indicator, along with a lot of other factors, but we haven't got there yet. So in a sense, I don't want to say that we're there, but I'm saying it looks like we're going there. Okay.
You had your hand up. Yeah. I'll get you. Wait till we have the mic moved over there.
Hi, thank you. This paper kind of pays no attention to the secular trends of demographics and home ownership. They just constantly reviews the cyclical trends, and they're terribly important. I mean, if you achieved a 70% level of home ownership, it's now down to 64. The question is, what's normality with regard to those trends? You know, you have the boomer, and I think that has to be addressed. Yeah.
Okay, no, I think that's a good point. I mean, when it says this was focusing, papers was entirely focusing on the business cycle, and was trying to show that there is some these business cycle patterns, and that it seems like there's something that there's a relationship that's held in the past, and the way things are going now, it predicts that it's going to come back, holding everything else constant. So I take your point.
Yeah, I'll get to you in a minute.
Maybe stepping out a little bit from the paper, in Figure 7, there is one part of the cycle where it was short-lived, and I was wondering if you gave some thought to what would cause this particular cycle to repeat the early 1981, be a repeat of the early 80s.
So remind me what happened in the early 80s?
That was the end of the Carter administration.
Okay.
Rates went down, then they went back. It was a very short cycle.
I don't know.
I do remember, Mickey and I think remember that. I think
Yeah.
the second quarter of 1980 was one of the deepest contractions in GDP on record in the U.S. At the time. It was a 10%, might have been revised, so I think that's a 10% contraction at an annual rate of GDP in the second quarter. Most everybody attributes that to this credit control program that was put in place and then lifted as soon as they realized how counterproductive it was. So that was a kind of a sort of a out of left field issue.
Okay.
I also wonder if the past relationships between home sales and economic growth are going to be the same as before, right? Because it's just like when people were making assumptions about default rates, but the actual underlying micro behavior had changed. And so I also hear a lot about private equity funds and foreign buyers are the ones that are pretty much buying up the inventory, and that doesn't necessarily translate into domestic consumption growth. So I'm wondering, how are you going to address that?
There's still this question of portfolio balancing that's been taking place, and retrenchment that's been occurring in this recession. And as the economy recovers, people are going to be moving back to their previous trends, and you still have households that are being formed. You've got immigration. You've got young people that want to own houses that have moved into their parents' place. So these factors, there's a sort of backlog, and that's going to take a while to eradicate. So I don't really think this recession recovery is going to end up being that different from the history.
Okay, I have one comment. If there are no other ones from the floor that try to tie these two of these together, your last comment and Marty's comment. It was a mystery, I think, a little bit of a mystery of why housing caused the whole world to come down. And I think the part of the mystery is that housing finance was linked to the money markets. It was linked to very short-term monetary financing, which has essentially created a massive modern banking crisis in a way. But then your comment is, the Fed's policies appear to be spiking the speculation in housing at this point too. So I think I think both the things I was saying are true, but I want maybe to go back to Marty and go back to you and ask the following. Do you think that on the way up, the wealth effect of housing coming back could account for what Mike is expecting, to Marty? And also to you, do you think that the Fed QE3 is spiking the speculative purchases of housing and pushing house prices up in a detrimental way? And so first Marty and then come back to you.
On the question of the wealth effect, I think one of the reasons why consumer spending is doing as well as it is, given that income is not increasing. I mean, real personal incomes per capita are essentially zero change over the last year. So the saving rate goes down, and I think it's a combination of the stock market and house values are causing segment of the population to be willing to cut their savings and to increase consumer spending. The saving rate is very, very low, even though the government has now confused the message by recalculating our savings rates. By the traditional way we did it until this last revision, the saving rate would be well under 3%. And so I don't think that you're going to continue to see declines in that saving rate, giving us the consumer spending to continue to boost the economy.
Mm-hmm.
I'm inclined to think it's actually helping more speculation. I don't see anywhere here where you're tracking the number of mortgages. And from what I had heard, speaking to folks, a lot of banks were not giving out a lot of mortgages. Especially like in New York City, I've spoken to mortgage bankers. They're not making a lot of loans. They say that a lot of the buyers are basically a lot of Chinese paying all cash and others. And so I just don't know if your assumptions are necessarily going to hold, especially given the weak recovery in jobs. And you say that, yeah, there are a lot of young people who want to start families, but they can't afford to purchase homes and therefore are not going to be getting those mortgages. So to me, it would seem that there's going to be a completely different sort of economic cycle that we're looking at, unless you have the same relationship that you had in the past. I don't see that necessarily coming back.
We have one quick question from Charlie to Mike, and then we have to stop.
So, this is a question that, in a sense, wraps up some of these comments and also ties back to Ben's paper, which is, I really enjoyed this presentation, and so I have two different interpretations of the presentation. I'd like you to tell me which you think is more correct. One interpretation is, this is a reminder that monetary policy should be thinking more than 3 months ahead, because despite the uncertainties about the parameters that we've just been discussing, there is reason to be cautious about expansionary monetary policy, and with the Fed having more than tripled its balance sheet, so that from a kind of insurance policy standpoint or concern about the risks of policy currently, if you took a medium-term perspective, you'd be looking at these kinds of indicators, and they would reinforce your desire to stick with some kind of a rule like Ben was talking about. Another interpretation is we should be using housing indexes as our discretionary guide for short-term knowledge about where growth rates of GDP are going. That would be, I'd have more trouble with that interpretation. So you're sort of two ways to interpret what you're saying, and I like the first way better.
Yes, so when I was doing this, I was thinking of the first way, and I was thinking you look at these longer run factors, and you set policy for the long run, and you don't look at these little indicators to make decisions in every 6 weeks or so. And so I was saying that there are these trends. There's a sort of historical relationship between housing recoveries and real recoveries. And so if you see that kind of a trend going on, and there may be there are these other short-term factors that both of you mentioned, Marty and over here. But even so, if it looks like it's going back, okay, and maybe it's too soon to say that, that's an indicator that you should be thinking in the long run and sort of thinking in terms of some kind of rule. So that was my motivation.
Okay, thanks, Mike. Now we'd like to hear from Mickey Levy.
But before I discuss my paper, I'd like to toss in my 2 cents worth on Michael's piece, and that is housing is bouncing back, but construction employment is barely increasing at all. And if you look at the detail, way less than half of all construction employment is related to residential building. It's much more so related to big infrastructure and infrastructure financed by state and local governments, and that's been a real missing link. So when we look at the composition of the slow economic recovery and the slow recovery in employment, from peak employment to where we are now, something like 80 or 90% of all the shortfall in employment is the decline in construction employment that has not bounced back. We can go into detail on that, but then that brings up Charlie's question: is it the proper role of the Federal Reserve to adjust its monetary policy to state and local government finances that are leading to weakness in infrastructure spending programs? And so it all ties back to the same thing about what's the proper role of the Federal Reserve's monetary policy. Okay, my paper is entitled Reconciling FOMC Forecasts and Forward Guidance. So the Fed is using forward guidance, that is guiding markets now about when it may taper and end its asset purchases and when it may begin hiking rates, really with the intention of suppressing interest rates until the economy strengthens and the unemployment rate comes down further, or as we recently learned from Chairman Bernanke, when employment accelerates and the labor force participation rate goes up. So, but at the same time it's providing this forward guidance on when to taper and when to hike rates, it continues to provide its official forecasts for the economy. And those are quarterly now, and they are based on the forecasts of each FOMC member. And those members are instructed to base their forecasts on what they think are appropriate monetary policy over the projection period. And also now, in addition to those official quarterly forecasts, the Fed also provides the assessments of the FOMC members on the appropriate future path of the federal funds rate. So my bottom line is, as the economy continues to recover, move further and further away from financial crisis and recession, and the unemployment rate falls faster than the Fed's own projections, a clear inconsistency has emerged between the Fed's own unemployment rate forecasts and its own assessment of the appropriate future federal funds rate. So let's just put it this way. The appropriateness and sustainability of a negative real federal funds rate through year-end 2016, along with a bloated Fed balance sheet, as stronger economic growth the Fed projects, pushes the unemployment rate down toward 5.5% by fourth quarter 2016, as the Fed projects, suggests an excessively accommodative monetary policy that's inconsistent with the Fed's long-run objectives and involves very high risks. Such inconsistencies on the Fed's part and its willingness to continuously modify its forward guidance, it only adds confusion rather than clarity and diminishes the Fed's credibility. And it steers attention away from the clear assessment that the Fed's asset purchases, QE3 I'm referring to, and forward guidance are not stimulating the economy. And the Fed would be much better off if it clearly established a strategy for exit from its unconventional monetary policy and stick with it. Now, I refer you to the table on bottom of page 2 of my paper that shows the FOMC's forecasts that were just released and compares them to those from June and March. So as you can see, the Fed has reduced its forecast of 2013 real growth based on the softer numbers than they had earlier expected. They have reduced their forecast of the unemployment rate as the unemployment rate has come down faster than they had earlier forecast. And by the way, you go back to the Fed's central tendency forecasts since they started in 1980, and the Fed in every recovery has underestimated the decline in the actual unemployment rate. And, but then you see the Fed, in its September forecast released on Wednesday, continued to forecast a strengthening of economic growth. It moderated that some in 2014. But really, when you look at their forecast for 2014, 15, and 16, they're forecasting a strengthening to above potential economic growth, and then they stick with their long-run assessment of 2.2 to 2.5. And now look at the unemployment rate forecasts. They have the unemployment rate continuing to come down to 5.4 to 5.9 in the fourth quarter of 2016. Seemingly, the Fed members are slowly but surely throwing in the towel on their earlier forecast of a cyclical rebound in the labor force participation rates. Meanwhile, the Fed has remained steadfast in expecting inflation to rise gradually to 2% and then stay there. And I might note, the Fed's forecast on inflation, long-run inflation, intermediate-term inflation, hasn't changed even with QE2 or QE3. So now, turn the page, and it shows the Fed's, the FOMC's assessment of the appropriate timing of policy firming, and I refer you to the bottom chart, which shows that in the long run, they, almost all of them, expect the federal funds rate to be to eventually go to 4%. And based on their forecast of 2% inflation in the long run and their objective, this makes sense, and it's consistent with history. But then how do you get there? And herein lies the problem. Look at, once again, this these charts. Even though the Fed is forecasting stronger growth and continued declines in the unemployment rate down to the natural rate, they think it's appropriate to keep the real funds rate below the rate of inflation through the end of 2016. You see the mode for their assessment for fourth quarter 2016 is 1 3/4%. Okay, and to me, this is an inconsistency. Why should the Fed say it's appropriate? And this is part of their forward guidance. Why should they say it's appropriate to remain extraordinarily easy when the economy is back to what they would call full employment and the like? So the challenge of over this last summer, the challenge of the recent quarterly forecasts as the Fed approached them was to involve trying to reconcile the earlier inconsistencies in their June forecast, and the Fed absolutely failed to reconcile these inconsistencies. Now, through all the Fed's mixed signals and forward guidance qualifications and confusion, by earlier this week, the Fed funds futures had priced in a Fed funds rate of 1.15 at the end of 2015 and 2.25 by the end of 2016. Now, as we all know, we could ask the question, why did the market before the Fed's announcement build in near 100% probability that, that the Fed was going to announce a tapering? And my clear observation is the Fed encouraged the market to that expectation and then changed. What I found striking was the Fed's, was Bernanke's post-FOMC meeting press conference, where he changed the goalposts on forward guidance, qualified it, changed it in 4 ways I can think about. One, he spoke in extremely dovish terms. 2, he basically said, as long as inflation is below 2%, this gives the Fed flexibility to remain extremely easy, assuming no lags between monetary policy and the economic outcomes. 3, the Fed was extremely data dependent in its monetary policy. And 4, he emphasized several times that the Fed's assessment is the overall labor market conditions are just as important as the unemployment rate. What are we supposed to do with that? Throw out the Fed's unemployment rate because now the Fed is concerned about overall labor market conditions, including the labor force participation rate, and in fact the government factors that may affect the supply and demand for labor. These add a lot of confusion. Now, I would also, in this same vein, like to point out that if we go back to 2009, when the Fed reduced the funds rate to 0 and it was at the lower bound, the Fed touted all of the tools in its monetary toolbox, but consider the combination of what we have now that the Fed's drawn out of its toolbox. The combination of LSAPs, Fed forecasts that now go out 3 years, Fed assessments of the future appropriate funds rate, the Fed's modifications of the forward and qualifications of the forward guidance soon after it provides the forward guidance. My general assessment is the Fed's toolbox is overused. It's full of confusion, and it hasn't gotten us very far. Completely lost in the discussion about and the speculation about the Fed tapering is the critical question that deserves debate. Have the Fed's QE and forward guidance really been successful? Okay, here's just some simple evidence. In the last couple of years, nominal and real GDP growth have not accelerated. Bank excess reserves have increased nearly dollar for dollar with the rise in the Fed's balance sheet with more quantitative easing. As the LSAPs have not stimulated more bank lending. And with regard to forward guidance, bond yields are now higher than they were before QE3. So as far as I can tell, these policies in the toolbox hasn't worked. The Fed argues that the economy would be much worse and unemployment rate would be and employment would be several million fewer if the Fed hadn't pursued these policies. But I would note that is based on the Fed's macro model, whose forecasting track record has been underwhelming and unreliable. And I would note that going back to 1980, from 1980 to 2005, 25 years where the Fed put together a central tendency forecast in January, in either 20 or 21 of the 25 years, real GDP was outside of that band, and their forecast hasn't gotten much better. And the bottom line is, it's just so obvious. Real factors, non-monetary factors, are inhibiting growth, and they're way beyond the scope of the Fed. So the bottom line is, the Fed is now stuck with providing quarterly forecasts, and it's stuck with providing its assessment of the appropriate funds rate. These are prone to inconsistencies and miscommunications about the future of monetary policy. But let's be realistic. How forward-looking is forward guidance that bases monetary policy on the next high-frequency piece of economic data? How can the Fed be transparent and clear when it really doesn't have a strategy? So my bottom line is the Fed should be much more circumspect about the scope of what it's capable of doing.
I
One
want to
more
leave
line.
some time for Q&A.
Okay.
We want to ask you questions.
It should be much more circumspect about what the proper scope is of monetary policy, whether the policies are actually working, and then set out a strategy for an exit and just stick with it and don't keep changing it because that's bad policy.
I would just add that just watching Mickey try to make this report is indicative of how confusing things have gotten. Anyway, we have a few moments for questions. If not, I will make one comment. I think of all the things that Mickey said, the thing that strikes me the most is that the Fed has realized that the unemployment rate is not giving it the indications that it wishes to receive. So it's changed the goalpost. What it seems to be worrying about is the participation rate. But to me, what the Fed is saying, it's increasingly seeing the low labor force participation rate as something that's more long-lasting. But in that very sense, to me, it's recognizing that whatever the forces are that are affecting labor participation, they're more secular than cyclical, which means they're going to be out of reach of monetary policy. So that, to me, is the fundamental inconsistency in what the Fed is trying to do. And that's what I heard from you, and I just thought I would...
And research from around the Federal Reserve district banks show that the labor force participation rate is due in part to demographics. It may be due to regulatory policy. It may be due to extended unemployment comp, disability insurance. Is it the proper role of monetary policy to offset those?
Well, to me, it's not an issue of what's proper, but there's a logical problem. The more you think this is a long-lasting effect, the less likely it's going to be amenable to monetary policy. And if you consist on pushing your policy with trying to get the participation rate up, to me, that's dangerous territory because it means you're likely to overdo it and create inflation. And that's what I hear you say. So I think that's consistent.
Yeah, and it's very frustrating when, okay, so the Fed's official blackout following its Wednesday meeting ended this morning, and there are already Fed members on the tape saying, well, we were very close to a tapering, but the data weren't strong, and maybe in October, but let's just see how the data are between now and then. That's not forward guidance, and there's no strategy there.
Okay, we're right on time, and so thank you, Mickey. We're going to switch gears. Maybe we should take 5 minutes, and then we'll start our second maximum, and we'll start our second session. Thanks.
I think it is clear how fortunate we are to believe in the power of ideas.
Supply the common sense and the fresh thinking of the Manhattan Institute.